So I am Steve Cook with Life and Air, and I just want to welcome all of you to this call here today. We are just grateful that Keith has taken the time to share with us. One of the things that I want to just put out there, I've been doing this for a long time now. I've been involved in the real estate world for about almost, I'm getting ready to knock on 23 years that I've been doing this. And, for me, it's hard because I'm sort of becoming the old man in the industry when I was the young buck when I was getting started and out there doing all this stuff. But I have met many different accountants and tax advisors, and even from a legal perspective, I've met many people who throughout the years, and I've met a lot of really, really good people. And so I'm really excited that Keith is going to be here with us today, simply because over the years, and as I have had the opportunity to get to know Keith, I got to tell you, and this isn't to take anything away from any of the others, but Keith is, in my opinion, the brightest, the smartest of all of the ones I have met in my 23 years in this business. And I think, and here's the reason why. This is why Keith is better, because Keith actually does the things that he talks about. Keith is actually involved not only as the CPA and the accountant, but he is somebody who's actually in the business of real estate and investing and doing different things with businesses. So it sort of separates him from many of the others who just do the tax side of things. And so I do want to just, before I actually have things get kicked off with Keith, I do want to just recognize we got a lot of people coming in from all over the country. As we are kicking off the Life and Air Connect groups, we have people who are coming from different ones. And I think that we have a big representation coming in from the Appleton area here today. We have people coming in from Tennessee. We've got people coming in from all over the country, for the call. And we just want to welcome all of you to the call. For those of you who are not already in the Life and Air app, I want to encourage you. You can go to the Google Play Store, you can go to the Apple Store, or you can go to lifeandair.com and participate in the community from your desktop. But we can continue this discussion afterwards in the app. You can continue, ask questions and things like that. But we have all kinds of discussions going on in there. And I just want to encourage you, if you're not already in there, jump in and download that. But Keith, before we get started, because, we've had some people who got here on time, some of them here were a little bit early. They might not be here at the end of the call. Before you even get into it, can you tell people how they could get in touch with you and reach out to you?
Sure. My email is keith@financialjourney.life. My website, financialjourney.life. I will say I'm no longer in the tax preparation business, so I'm not looking to become all of your accountant, but I see myself now as a tax strategist and somebody who helps people work with reach financial freedom. So I just work with a small group of people. So for me, this is more of a way to share with you guys and hopefully give you guys some tools to do this on your own, or know when to approach your CPA to work through some of this.
So that's how you can get in touch with Keith. So Keith, I want to just thank you for taking the time out of your day to do this for the community. I know that it's going to be valuable. With 2020 has been sort of a crazy year, and I'm sure along with that, there's probably going to be some unique things that we have to consider for end of year tax planning that might be different from previous years. And but I did go ahead. I just made you the co-host. And so if you want to, I don't know if you want to talk a little bit about yourself first, or if you want to jump right into your presentation, but I'm going to turn it over here to you.
Perfect. Well, thank you, Steve, for that introduction. It's very humbling. Now that people think that I'm the best, I need to give the best presentation ever. So I'm going to do my best, but that's a lot of pressure on that. So I prefer to set the bar really low and then exceed it. This presentation is meant to give you an idea of what you should be looking for from a tax perspective. I'm not going to try and teach you how to do everything, but at least point you in the right direction. I could go for days talking about tax stuff and it would be exciting to me, but you guys would not want to be my friend. But by having just a little bit of knowledge, you can at least know what you can be doing or when is a good time to go ask somebody. And having that little bit of tax knowledge can really save you a lot in taxes later. I will also say just the standard disclaimer, if there's anything you want to apply, go talk to a professional. As I mentioned a moment ago, I'm no longer in the tax preparation business for now. My quick 60-second story is I started at Deloitte, a major CPA firm in San Francisco, did a bunch of stuff in real estate. I used to have a CPA firm in the Dallas area where I really catered to high net worth real estate investors, had a lot of home investors, clients, people doing complex transactions, or people owning commercial property. And so I really got some, I enjoyed doing the complex planning that goes into that. I sold that business in 2016. Now I do a little bit of tax strategy just for a small group of clients. So right into the presentation, Biden's campaign talk. So he hasn't actually put out a formal tax plan. Since he's not taking office till 2021, don't expect any changes for 2020. 2021 would be the first year of planning, but there's a good chance that none of the stuff that they implement will even get implemented until 2022. And the fact that I believe we have a Republican-controlled Senate, we're going to have a tough time putting in really sweeping changes. So there's going to be, from a political standpoint, maybe a little more compromise. And so, but I will share what he did talk about is raising the top individual tax bracket all the way up to 39.6% where it was previously. And then for investors, for those who have maybe a large sale of something where you got capital gains rates at the highest rate if you make more than $1 million in income. So where this is applied for me on some of my clients is maybe we're looking to accelerate capital gains in 2020, just so we're not potentially going to 2021 where they're having to pay that higher rate. That's kind of a case-by-case decision. I'm trying to defer income. And so this is a decision that's made in consultation with the client and whether or not you'll think you'll have high income in 2021 as well. He also talked about eliminating the $10,000 ceiling on state and local taxes, SALT. So for those of you that live in a higher income tax state like California, Wisconsin's not terrible, but anytime your sales tax, property taxes, state income taxes go over $10,000, you stop being able to get that deduction. So I know in certain places, the year that you pay your property taxes, if you don't escrow with your mortgage, you can decide what you're going to pay it in. So in Texas, you have a window between September and January. And so I can decide when I'm going to pay some of those taxes. So I'm actually trying to deduct $10,000 worth of taxes in 2020 and then defer the rest to 2021 on the chance that maybe it becomes allowable. I will get through the presentation. I think I see a comment coming in. I'm going to try and get through this presentation and then take questions at the end just to make sure that we get through the core of the material. And I'll let Steve moderate those questions or chime in if you really want me to clarify something in the moment. There's also the elimination of step up in basis at death. So typically, as of now, when you die, let's say you bought a rental house for $100,000. You own it for 20 years, you pass away. It's now worth $300,000. Well, your heirs could sell that property within 6 months and there's no capital gains at sale. If it's longer than 6 months, then they just need to get another appraisal of what it was at the time you passed. And so he wants to do away with that tax loophole he's saying for the rich. And then also dropping the state minimum estate tax. As of now, there's almost no estate planning you need to do if you're less than that $11.5 million. He's wanting to drop that down to $1 million, meaning that if you die with a net worth over $1 million, then you get taxed at like 50% of everything you would want to pass on to your heirs. Some would call that extreme. changes likely won't take effect till 2021. So common sense tax planning. We'll get into the actual tax planning component. Would you spend $1 to save a quarter? I've often heard the phrase from people, hey, I'm buying a new car or I'm spending money on X, Y, or Z just so that I can get a tax deduction. So in response, I've given the offer, if people want another tax deduction, I'm willing to charge you $100,000 in fees and you will get $100,000 deduction that you got to spend on professional fees. And then you'll save $25,000 in taxes. So far, nobody's taken me up on that offer just yet, but I use that to illustrate the point where it needs to make sense. If you're spending money for a tax deduction, you better want to have that expense or whatever it is you're spending on besides just the tax deduction. We don't want the tax tail to wag the dog. So how do you do your own year-end tax planning? So I'm going to run through conceptually how to do this, and then I'm going to run through an example in an Excel spreadsheet here in a moment and show you actually how to use that same Excel spreadsheet, and I'll share it with Steve or whoever, try and get it out to you guys in some shape or form. So you start by knowing your numbers. So I would run my accounting, either do it myself or get with my bookkeeper, and January through November, October, whatever you can to get the most up-to-date books. And that way you've got a good estimate of what your business has done for the year. And then I'm going to estimate for December. So one, just knowing where I'm at. Up until that point, it's really just an estimate. It's not going to be perfect until the tax return's done. So you're going to estimate your income, your deductions, capital gains, and maybe even tax brackets if you got different entities like C corporations or trusts. Then you can ask yourself which entities can or should have more income or deductions. So I'm not saying to do anything illegal here. I'm suggesting sometimes there are ways where you can legally move income or expenses one way to the year to the next. For example, maybe you've got some invoices for if you're in the service-based business and you delay sending some of those invoices, not intentionally, but you're just not as pushy. You know you're going to get the money eventually, so maybe you send those in January. Or maybe you could stock up on supplies like inventory or other things. Maybe you do that sooner if you want to accelerate expenses. If you're looking at your C corps or your trusts, you can evaluate your dividends, what effect those dividends will have on your personal tax return. So you're kind of looking at all these different components to figure out the best scenario for you. Some of this is a little more complex, so we're going to break it down into something a little easier. We'll assess the strategies available, and I've got a list of just simple strategies that you can use to help legally manipulate your tax brackets. At the end of all this, after I have this information, I'm going to analyze and optimize. So I'm going to look at things from different tax brackets, various tax credits that might be available, at what point certain tax deductions phase out. So some of you might know the qualified business income deduction. Once you go above, depending on your filing status and exact income level, around $300,000 in income, you may no longer qualify for that qualified business income deduction if you're in a naughty service, like you're a service-based business primarily based off your know-how. It's possible that you no longer get that 20% deduction. So usually somewhere around 300,000, there's a lot of deductions that start to phase out, and maybe new taxes that come into play. And so as you become aware of this, it's easier for you to kind of guesstimate what's your sweet spot in terms of showing income. There's also the $2,000 child tax credit, all these things that come into play. On your S Corp distributions, you may know that you can use your S Corporation to avoid self-employment tax once a reasonable salary has been paid. So for those in like some sort of a service-based business, coaching, consulting, maybe flipping, depending on the nature of flips, once you go over about $50,000 in income, I think it makes sense to get an S corporation. But if your income is, say, about $100,000, let's say you pay yourself a $50,000 salary, everything above $50,000 is no longer subject to self-employment tax. So $50,000 times the 15.3% self-employment tax rate means you're going to save $7,650 in self-employment tax every year, which is fantastic. So if you weren't aware of that strategy, I hope you just got your money's worth out of this webinar. So part of what I'm asking at the end of the year is, was my salary enough? So if I paid myself a $60,000 salary, was that reasonable? If I was losing money all year, I probably don't need to pay a bonus or even really need to take a salary for a little bit. As an owner, if I'm losing money, why would I pay myself until I get to that point? Versus if you paid yourself a $60,000 salary and you had a phenomenal year and you have a $200,000 net income, well, maybe you should bump that up, and maybe you give yourself a good sized year-end bonus at the end of the year to get that threshold. Just as a general rule of thumb, I usually like my salary to be somewhere around 50% of whatever my net income is, on up to about 150,000. Beyond that, there's other factors that might come into place. That's just a rule of thumb. So year-end checklist. I'll maybe look at if I can include my kids in the business. So if I'm in a real estate business, are they managing property, helping do demo? Giving a kid a hammer or a sledgehammer to go knock down walls can be fun for the kid. Can be some great memories for you as well. So you can pay them a salary of $12,400 up to $12,400 per kid in 2020. And what that means is, because it's active income from them, they can go up to that threshold and they don't have to file any taxes, a tax return. You get a deduction on your tax return. It saves you that amount of money. There's no payroll taxes, anything like that, because they're your kids, and they can then turn around and put that money maybe into a Roth account that's later used for college savings. A Roth IRA is usually my go-to favorite for kids as a general rule. There's all sorts of stuff, but if they get into even a self-directed Roth, then they can start investing. You can teach them about finances. If you're having your kids go above and beyond what they would normally receive from you, you could have your kids maybe use their own income, teach them about finances, and maybe they're buying clothes for themselves above and beyond what they would normally have to spend. Or maybe they start paying for private school or sports camps or things like that. And there's different ways to teach kids about that. Now, it does need to go in their own bank account. It just can't deposit your kid's check back into your own account and pretend like it's not really theirs. For charitable giving, you can go up to 60% of your adjusted gross income. Normally, if you're feeling really generous, you can actually go up to 100% in 2020 due to COVID. You can gift $15,000 per spouse per recipient. So if me and my wife want to gift to another family, their spouse, we can actually give $60,000. Sometimes I'll switch between odd or even deductions on my Schedule A. So I'll explain this more on the Excel spreadsheet. I think it'll make more sense to see that visually. But the short version is, there's a standard deduction of almost $25,000 for the year. Maybe one year you're itemizing where you're maxing out your charity and all the expenses you can on the itemized deduction. And the next year you have lower itemized deductions, and so instead you take the standard deduction. You're going to review all your expenses for the year and try and determine what can be deductible. So if you used your telephone for business, your internet, make sure those are deductible. So there's little tricks to each of those. Really, you can pick one telephone bill in the year, maybe it's, and you go through and you look at all the phone calls and decide what was business versus personal. I would, and apply that same ratio to all your bills for the year. I would suggest you picking the month where your business use was highest. Maybe you were doing a lot of deals. Internet usage, often I see around 50%. You decide what's right for you, but 50% for me has just been a good threshold where I know 50% of the time I'm using it for entertainment. The other 50% is my home office from home. Officer retreat. If you and your spouse are working in a business together, or you think you need to go do planning, maybe you go do planning from someplace tropical, someplace that you really want to go, and you go do business meet there. You need to actually legitimately do business planning and thinking, but maybe you're doing some of your life and air vision, the business part of that from someplace nice, because you think better because someplace nice. Another little trick here, if you make that an all-inclusive, then you don't have to worry about substantiating whether or not meals and entertainment should all be deductible or not. That's all included in there in the resort fee. And so it all ends up having to be deductible as an officer retreat. And there's any travel, maybe you're traveling to a Life and Air 3-day or a Life and Air retreat, and you believe your membership with Life and Air is primarily for a business reason, at least you're getting a lot of benefit from there. So maybe you're deducting all of that. Meals that are related to business, make sure you document any events. So maybe for you that have been to Tony Robbins or something that really helps you with anything that really helps you with your business, you find a way to deduct that. And then of course you can also reimburse for your auto mileage. So all of these expenses shouldn't just be a paper thing. You should actually cut yourself a check or make some sort of a money trail with some documentation to make it legit. Home office, I'm going to talk a little bit more about this because a lot of people have had new home offices this year out of lack of choice. So all your office furniture, equipment, improvements, internet stuff directly related to your physical space of the home office can be deducted 100%, assuming it's all 100% for business. There's also some indirect expenses that are usually taken in relation to the square footage of your home. So if your home office is 200 square feet and your whole home is 2,000 square feet, then you can take 10%, 200 divided by $2,000 is 10%. And so you take 10% of your mortgage interest, property taxes, insurance, your HOA, cleaning, repairs, things that are related to the house as a whole. And then maybe you're doing rollovers of cash or investments. So you can roll over an investment or the cash from a traditional IRA or 401k to a Roth. And there's actually some strategies to get discounts on those investments, so you're not paying the full price. Tax deferral, you can plan the date a property is available of sale. So I'm not going to delay 3 to 6 months for a property sale, but if you're in December and you're around the same point anyways, maybe you move your closing date to January 1st, because now you get to recognize the capital gains 1 year further out. You can plan the date the house is available for rent. That's when you actually start taking depreciation. So if you bought a house in October, November, maybe you push to make it available for rent here by the end of the year so that you get to start taking that depreciation earlier. You can always do an installment sale. Maybe you're selling via owner finance or something along those lines that allows you to break up the sale and over time. There's various strategies like that. To accelerate your expenses, you need to pay whatever year you pay your property taxes in. You need to write and mail any checks. So maybe you're paying some bills early, or you're increasing your inventory, your supplies. You get at least through 2022, I believe, you get 100% bonus depreciation on all your new assets. So if you install carpet, appliances, fence, anything related to your businesses, you can take that as 100% deduction. Now, estimated tax withholding trick. So you probably heard that for business owners, you should be making quarterly tax payments throughout the year. And if you don't, then there's a little penalty that you can pay, usually 3 to 6%, depending on how various factors, including the current interest rate. Currently, it's pretty low. So one of the things I like to do, though, is if withholding is done through your W-2, that you attribute it to you making those payments throughout the year. So maybe you give yourself a $60,000 salary through your S Corp all year long, but you get to the end of the year and you're like, oh crap, I need to both get my salary up higher and I didn't pay in enough on my my withholding. I owe a bunch. So now I'm going to give myself a $10,000 bonus check to myself to increase my salary. And I'm going to make nearly all of it go towards my federal withholding. So on that one check, I'm going to maybe increase my federal withholding to $8,500 of that $10,000. So it's a way to get more in, and there's no penalty like you would have done had you made that same payment through like a December quarterly payment. It's really January 15th. Ways to change your taxes after the year. So this is what I'll do when I start taking on a client. I want to review their tax returns and see what they've done for the year, get a draft of that tax return, and I'll look at these levers on how to manipulate things legally after the fact. So one, I'll review all their expenses and make sure they're deducting everything they're entitled to. And sometimes, often 20-30% of the time, I see errors on the tax return by just adjusting a couple things. They can go back to the CPA and save sometimes tens of thousands of dollars. You can still make contributions to your tax deferred account. Now with 401ks, you can actually do that up till April 15th. On IRAs, that can be extended all the way out to your extended filing deadline when you file the tax return in October 15th. You can do a change of accounting method, which means you're going back and you're doing a cost segregation study on property you bought in years before. You could be changing between cash and accrual basis or vice versa. Safe depreciation, safe harbor, so you can deduct up to $2,500 depending on the nature of your business as an immediate expense instead of capitalizing it. Maybe you're doing the 100% bonus. Maybe you don't want a 100% bonus. Maybe you think that in the Biden era, there's going to be higher taxes. So you want to do straight line where you take 20% a year for the next 5 years. We can look at partial dispositions. If you replace the roof, then you can get an immediate write-off for the old roof when you do the new roof. Especially special allocation of sales price. Traditionally, most accountants at an asset sale allocate all the sales price pro rata across all your assets. I think that's a mistake. So, for example, if you buy, you own a rental house or an apartment complex, and you bought a $500 appliance. Let's say 5 years goes by, you double your money on the property at sale. Then the accountant's going to say, you bought that at $500. We're going to double your money at sale. So we're going to allocate $1,000 sales price to that appliance. And now under that example, you'd have $500 worth of depreciation recapture at ordinary tax rates. And then plus you'd have the other $500 at maybe 15% capital gains rates. Under what I would suggest special allocation of sales price, we know appliances don't increase in value. We know they decrease in value. So maybe an appliance that's being used in a rental house for 5 years, what's it worth? A lot less than what you paid for it. Maybe that's $100, $150, maybe even less. I'm going to come up with a reasonable method based on those assets. Maybe I determine it's worth $150. Then in that example, that appliance is assigned $150 worth of depreciation recapture. And now I've got 850 at long-term capital gains rates instead of ordinary stuff. So I know I'm running through what are potentially some really complicated concepts rather quickly. The point is that you get an idea of what to look for and maybe what to question, so that later this can be brought up to your accountant or you can look at this and say, hey, what about this? And some accountants have just never even thought about this because it's a little out of the box, but it's very legal. I can go back and point to the regs that allow you to do this stuff.
So on that note, Keith, can I just ask what are maybe the top 2 or 3 things that your typical accountant is going to miss that people could benefit from?
Special allocation of sales price, huge. I will say almost nobody's doing partial disposition of assets. But your average mom and pop CPA is not going to know how to do it. Special allocation of sales price is probably one of the biggest ones. Cost segregations, people are familiar with. And then just reviewing all your expenses and deducting everything you're entitled to. So as we get to the tax planning, just looking at everything you do that somehow has a business function, finding a way to deduct that. So review of elections of activities. So at the end, I will make sure that qualified business income deduction. So I want to speak real quickly to this one, because this was a major error I was seeing with CPAs. Is I review a lot of taxes prepared by other people now as a strategist, and so I see how people are doing things. And one of the mistakes is people are often able to generate losses from the rental real estate, which is great. But the mistake is then accepting the qualification of that as qualified business income. So you can, it's an option, elect to treat rental property as a business subject to qualified business income, but you don't have to. It's an optional election. So if I'm losing money and I'm taking this election, that means now I'm accumulating all these losses that I have to then have income to offset in the future before I can ever accept qualified business income. So let's say I'm losing $20,000 a year from my business because of depreciation. Then I could, instead of taking the QBI deduction initially, I could lose $20,000 year one, $15,000 year two, $10,000 year three. So in total, that's $35,000 I've lost. Let's say I passed on making that QBI deduction. Year four, I've got a lot of income, and that's maybe when I'm selling something, whatever it is. If I haven't taken the QBI deduction, then my $100,000 profit in year four could all be 20% of that $100,000. I get a $20,000 QBI deduction. If instead I've accumulated $35,000 worth of losses, I have to do $100,000 minus $35,000 in carryover of losses. Now I'm taking 20% of $65,000. So this is one of those simple ones that I catch. Do you qualify as a real estate professional? Are you allowed to take those losses? If you're a real estate professional or you're actively in your business, your real estate business is a business, then you should avoid the 3.8% net investment income tax. These are just like check boxes for an accountant on the tax return, but it's something that people often miss. Where do I start? So pick tax strategies that match the size and sophistication of your business. I would say, depending on where you're at, maybe meet with your tax preparer before the end of the year to help implement. Discuss big decisions with your CPA. I do want to run through this Excel spreadsheet about planning real quickly, and then I want to open up to questions on everything that we've talked about. So I'm willing to share this planner with you. I'll let Steve decide how he wants to get it out to you. Maybe there's a way to share it in Zoom notes. I haven't tried yet. So this is just a simple version of how to do your own tax planning. I've used way more sophisticated software. There's way more sophisticated Excel spreadsheets, but this is meant just to be a simplistic, quick and dirty way to estimate your taxes and have it reasonably accurate. I'm trying to just get you in that, get you 80% of the way there, because that's going to be a heck of a lot closer than not doing this at all. So what I would do is I'd start by listing all your company sources. So whatever businesses you have, if you have interest income, if you have a job, put that in here. So typically all your wages, all your ordinary income is going to be in this section, and that's what's going to be taxed up to currently 37%. Your capital gains, this is what long-term capital gains rates, typically 0, 15, or 20%, depending on your income tax bracket. Federal withholding, what you've paid in, any state withholding, whether or not it qualifies as business income. If you're under $300,000 and you have a business, you can assume just as a guess that yes, it does qualify. If you're over that, then you're more likely to be a no. So total all this up, 22,000 in ordinary income. And then we're going to, this is going to actually be like your adjusted gross income roughly. And then we're going to try and figure out your taxable income. So your qualified business income deduction would come off of this. Your standard deduction, what's higher, the standard deduction for the year or your itemized deduction. So this is where I was talking earlier, where you can look at your mortgage interest, your charity, and maybe 1 year you're doing 0 charity and you're still always going to have your mortgage interest, but maybe you can defer paying your state and local taxes. Like if you've got, in Texas, I don't have income taxes here, so I just have property taxes and I can manipulate that. So in this example, I've got $20,000 in itemized deductions. So I could maybe take the standard deduction this year, and then maybe next year I maximize my charity deduction. And in that example, I'm deducting $60,000 in that year. So this is where you might be able to see where you can flop back and forth between even and odd years. 1 year you do itemized, the other year you do standard. You can also Google this to get more thorough examples. I know I'm kind of running through this quick. So you've got your standardized deduction or your itemized deduction. here. And then your that's going to offset your taxable income. Below that, we'll do a rough calculation on what your taxes are. I will say, so here I'm asking you to hard code this number. For me to build all the formulas in here would be a little bit more than what it's worth doing in Excel. So I'm suggesting either one, you're going out to like the Columbus Life Insurance app is just a free service I like. You've got the website where you can go do this, or you can just use last year's effective tax rate. So take not the marginal bracket, but whatever your effective tax rate was last year, if your income's about the same, and just multiply your taxable income by that rate. And then likely your capital gains is going to be at 15%. And so this is just meant to give you a rough idea of what it is. You get $2,000 tax credit per kid. So you could, however number of kids, $2,000. And then lastly, your federal withholding. So whatever income has maybe been already withheld from your W-2s, any quarterly payments you've made, maybe a year-end tax plan payment you plan to make as an extra check. Maybe that's through a W-2, a bonus check that we mentioned before. In total, we're calculating what your federal withholding is. And then we've got a federal tax amount due. I kind of like having a small federal tax balance due rather than having the government owe me, because really that's just a tax-free loan to the government. I know there's all sorts of philosophies out there. That's just my personal preference. And then ultimately you can do the same thing for the tax side. So this is really just to give you a real quick, brief estimate of what things could be or how things might turn out. And then you can, and then it's not such a surprise come tax time. And then in terms of business deductions, so rather than me putting a template together, I wrote out what I like to do to figure out my business deduction. So I'll run through all my bank accounts, my personal bank accounts, my personal credit cards, anything that's already not accounted somewhere in like accounting or bookkeeping software. I'll export that all to Excel. That's my personal preference. I'll sort it by name, by date, by amount, and I'll look at that different ways to try and find stuff that maybe I missed that could be deductible that's not otherwise deductible. So at the end, I'll total up those business expenses. I'll maybe decide what should be reimbursed. If you've got multiple businesses, what business makes sense to reimburse that. And then I'll print like an electronic record. So if I decide after reviewing all my business expenses that $6,000 worth of business expenses should have been deductible, then maybe I'll cut myself a reimbursement check from my business to my name personally to reimburse for those expenses. And now there's now a deduction in the business, and I personally don't have to recognize that check as income because it was just a reimbursement of expenses. And then as part of this exercise, I know some people are really strict with budgeting. At a minimum, I suggest at least ideally twice a year, you're going through and reviewing all your accounts for like reoccurring expenses or money you're spending that you're not getting value from. And this is a great time to do that review. So you're looking through anything that you realize you're spending, you're becoming aware of it. And usually just by having an awareness of what you're spending that you're not getting value from creates change within itself. So that's why I suggest taking that extra step, because you're already looking at your accounts anyways. As a quick home office deduction, I put this spreadsheet here as a quick way for you to estimate what your home office costs you for the year. And then at the end of this, once you put in your square footage, then you can actually decide you're going to cut yourself a reimbursement check for $5,000, especially if it's outside your personal tax return, like an S corporation. That's maybe where this makes sense to do. And then I also threw in a quick checklist of different deductions that might apply to you. Some quick ones that people often miss. People don't think to reimburse themselves for charitable travel. I know a number of people in this call have been down to Guatemala there's a school that Life and Air supports down there. I've been down there quite a bit. So your plane tickets and cost to get there should be, and like lodging should be deductible as a charitable expense. And then another one that that people often miss, you can rent out your home up to 14 days in a year. So if you're hosting an event with business people, you're throwing a 4th of July party, a Christmas party, and it's primarily business reason, you're hosting clients or you're hosting employees, then what does it cost to rent your home for a day, given the size and the nature of the event? And maybe look at Airbnbs for similar properties around those dates as your home. And then your business can cut you a reimbursement check personally, document why it was rented for business. And then you don't have to recognize that personally as income as long as you rent it for less than up to 14 days a year. So with that, I'm going to hit pause and let Steve come in and ask any questions or help me get through questions. And we'll go from there.
All right, we have a number of different questions. I'm just going to go in the order that they actually came in. So the first question was, Keith, can you please discuss donor advised funds, the pros and cons?
Yes. So donor advised funds, there's several ways I look to give money, and donor advised funds is an option. And what that is I have a fund that's set up that's really just controlled by me and my family. And I get a deduction from the moment I contribute money. And then when the money goes out, it can actually be in other years. So let's say one year I've got a big windfall. I sell a big piece of property. I make $500,000, usually $1 million. Usually you want a larger amount, usually a couple $100,000 plus before you even think of a donor advised fund, but it allows you a big charitable deduction in the year that you do it. And then you can actually spread out the actual gifting of that over multiple years. It's kind of an intermediate level between you gifting like just money directly. It gives some opportunity for tax planning and a deduction that you give, but it's an intermediate between giving your own like just cash versus having your own public foundation, charity, or having your own private foundation. And so that's why I think it's a good point in there. One of the cons I would say is you still have to gift through public charities for it to be deductible, versus if you had your own public charity, at least a third of the money needs to come from other people. But then as a public charity, you can decide who's going to receive money, and they don't all need to be other charities.
Awesome. All right, there was a question, are these handouts going to be made available? What we're going to do when Keith does provide me with the spreadsheet, and we're going to go ahead and we're going to put that as a post inside of the app. We will attach it there. We will also put the link for the recording to this whole presentation in there once we have that ready. So we're going to just create a post. We're going to take all the resources from this, and we'll put it all there in one place. The child income credit, is it for 18 and under only, or can you claim it on college students as well?
I know it's 18 and under. I think it's just 18 and under. I'd have to go back and refresh my memory on that, but I think it's just 18 and under.
All right. The $12,400 per child, what if the kid has another job?
Then that would be included in there. So you could do $3,000 from his own job and another 9,000-ish from you.
So anything up to 12,400 will be tax-free, but
yes.
Once they exceed that, they'll have to start paying taxes on it.
Yeah, and I will also say the exemption, there's no longer like the 4,000-ish exemption like we did in the past. That all got done away with in 2017. That's why we've got the child tax credit now.
So just a further explanation on how to pay a child without payroll taxes. I mean, the reality of the situation is whoever is doing your payroll, and if you're doing that yourself, it really boils down to that because of their age and up to a certain income, there aren't any withholdings. Is that correct?
Yeah. Yes. So sorry, I was looking at, you have to be up to the age of 17. So really a 16-year-old to qualify for the child tax credit, just in a quick search. In relation to paying your kid, if it's your own business, that's where you can avoid the payroll taxes. If another business that is not related to your kid is paying them, they still have Social Security, Medicare, those kinds of taxes. So up to 18 in your own business, that's something you can file through your payroll provider. I personally love Gusto just because it's so easy to use. There's no Social Security or Medicare taxes. And then on up to 21, there's no federal unemployment taxes, but between 18 and 21, you would have Social Security and Medicare.
Awesome. If it's a single member LLC, can wife be an officer?
Yes. So I would say that she's somehow involved in the business, that she's discussing things with you, and there that opens up a bunch of other alternatives. Even as a single member, husband and wife can either be treated as a single member uniquely under the IRS, or they can be treated as separate and file as a partnership. So that's a unique thing you can do there with them.
All right. Here is someone who said, my CPA did not want to use the home office indirect. He thought it led to more audits or the home office credit. Is that still reasonable?
So here's the truth with audit risk. A lot of people make guesses, but nobody really knows. A former client of mine used to program the IRS computer that would help determine what audit risks were. And we had some really interesting discussions about that. And so the more activity you have going through your personal return is going to increase your audit risk in general. There's a reason why I love getting things off my personal tax return. So if you do, if you're in that $200,000 to $1 million range in income, you've usually got somewhere around a 2% chance of being audited. Now, if you do that same activity through an S corp, you got a 0.2% chance of being audited. So you get a tenfold decrease by running that through another entity. And so that's why I like having my S corporation or whatever foreign other entity you have cut you a check to reimburse for that home office, because it is not so blatant. You can just cut it as office reimbursement. If you just put it in other deductions on the S corporation, just an office reimbursement, the IRS would have to do a full audit to even know what that is, versus you do it through the personal tax return. There's a whole schedule just devoted to the home office on that sheet, which makes it much more apparent. And none of this isn't illegal or shady. This is just using the forms that they give you to do it, and knowing how that plays together.
That's awesome. So bonus depreciation, this applies to a property acquisition without buying new assets that come with the property?
It applies to improvements. It applies to the acquisition. When you buy a rental property, you typically need to do like a cost segregation study in order to get that. And what you're doing is only the asset classes like 15-year property qualify. And so if you're buying new stuff like new appliances or new carpet, fence, like all that stuff's really easy to figure out on the fly what that is. But existing properties where that's a little more tricky. I will say to a lot of people think cost segregation on single family sounds expensive. It can be. Your average cost segregation study on a commercial property is like $3,000 to $7,000. Doesn't typically make sense for single family. But for rental property, there's a software cost segregation tool. kbkg.com is a California CPA firm that has a residential cost segregator. I've used it a lot for when I'm working with clients. It's $400 or less, depending on if you're buying on bulk, to do a cost segregation study for them. And at $400, I think that makes a lot more sense. And it's a way, I'll go and share one of my favorite tax strategies is when somebody has a lot of capital gains in 1 year. I like to see if there's a way that we can eliminate your ordinary income for the year. So capital gains, the first $80,000 worth of capital gains, if you've got no ordinary income, is taxed at 0%. So we tax 80,000 at 0%, then we max out the 15% tax bracket, and then maybe we have some at the 20%, but that's a way to save a lot of money. And one of the ways I do that is I'll look at all their rental property. If they have a bunch of property, go back and file cost segregation studies for the last 15, 20 years worth of property, depending on, we'll prioritize like how much benefit you'll get for each property. And we'll go through and we'll do 5 to 15 cost segregation studies to make sure you've got no ordinary income for the year. And now we just drastically lower your tax bracket on all those capital gains.
Love that one too. All right, so this is a terrific spreadsheet. Where would possible IRA contributions fall into the spreadsheet? Just be
Great
deduction.
question. Maybe under other credits. I don't know if it's technically a credit, or maybe you take it as a deduction. So this is meant to be simple. There's all sorts of things you could add to this. So if you just want to add a line and build it in there, I'm not going to lock it down or anything. It's just a simple spreadsheet. So you can just add a line and do it.
What type of business entity would be able to deduct an office retreat?
I think any entity could do that. It's just whether or not it's a legitimate expense. You're legitimately talking business with people that you should be talking business with. For me and my spouse, that's an important part. At least once a year, if not maybe twice a year, we'll sit down and this is where our business went for the year. This is where we want it to go. What kind of changes do we want to make? What part do you want to have in the business? And my wife is a huge part of that. And so that's why I believe those are an ordinary and necessary business expense. Plus they're fun.
All right. Wants to know if you could confirm that you can write off startup expenses up to $50,000 for a new business in its startup year.
So I remember it's up to $5,000, 100%, I believe. Up to 50, there's now you need to amortize it over a period of time. There's, depending on the nature of those expenses, maybe there actually can be disallowed the deduction of those. So that's kind of I'm a little rusty on this one. I often with real estate may lump those into the purchase of the property, depending on what your business is. So I'll say that's a facts and circumstances test on once we go above the 5.
Okay. This next one, you need your crystal ball. So should we expect interest rates on mortgages and HELOCs to increase with a Democrat as president?
Ooh, I think the government as a whole is really hurting from a debt perspective. There's a economist I follow, John Malden, who's just, he works a lot with senators. He works with a lot with different Congress, other guys. He's, I would say, a real expert, a real economist of economists. And he seems to think that our national debt's going to go from 20 to 30 trillion by the end of this decade, and possibly be at 50 trillion by the end of 2050. His projections are showing that we are way beyond where, even if we put our tax rates up at 80, 90%, we still can't pay it back. And so the higher the interest rates are, the faster that debt goes. So the government is incentivized financially to keep that as low as possible, to kick that can down the road for a while. And at some point, I believe there's going to be a day of reckoning. I think all of 2020, this next decade is going to be a rough decade. You can look at books, The Fourth Turning, or other ways where we've got a mixture of both a social reset and an economic reset that are overlapping, that go in cycles that are overlapping. So all that to say, I think the government is incentivized to keep things low, and you shouldn't plan on getting rich anytime fast from savings account. And I think the people getting hurt the most are those who are going to be the lower and middle classes, who have traditionally been able to make a decent return from that. Now they're incentivized to go spend it because they lose it to inflation.
Yeah. So maybe this one doesn't make a lot of sense to me, but I'm going to read it because maybe it makes more sense to you. What schedule is for the home office deduction?
What IRS form number is what I think that's asking. It's 80. I can tell you that in just 10 seconds, just in a quick deduction. That is 8829.
Okay.
On a business, if you're doing reimbursement through like an S corp, there is no form. It's just a simple deduction, and you just substantiate it, maybe through that form I showed on the in the Excel spreadsheet I gave, where you kind of calculate it there.
Does the cost segregation, must it be done by a cost segregation professional?
The answer is yes, at least it needs to be done by some sort of cost segregation professional. What KBKG has done is they've said we've got a process that works for anything under $500,000 where we don't think it needs to be. And they've said that if you get audited, we'll provide the audit support free of charge. That's just part of the package. And they're a good regional size CPA firm out of California that I expect could handle that. They won't do your entire audit, but they'll handle the part related to that. So I feel really comfortable using them. They're more of a business to business. So they really market themselves to other tax professionals, which is why you probably haven't heard of them, but they're one of my favorite cheats or solutions for that low price.
All right, here's our last question in the chat right now. And so if someone built an addition onto their home for a home office, can they deduct the whole cost of the build?
Yes, but I think you should depreciate that new structure. So that would actually be over 39 years. So yeah, that may not be, I would try and push as much as I could towards a repair. If we're talking just a few $1,000s, it's probably something you can get away with. But if we're talking, I'm guessing more like 10 to 30, you're going to need to depreciate at least part of that.
More like 40,000. Was my question.
Must be a nice home office.
It's really nice. It's got a home gym in it too. So we made it really nice.
I would, yeah. And if you include the gym part in it, I'm guessing that's not part of your business. So maybe 50% of that 40,000.
He has to continue to look that way so he can keep on getting business.
Part of the marketing.
So we don't have any other questions in the chat. Keith, did you have more that you wanted to go over?
I could keep going for a while and just talk more depth of other strategies. If there's an interest, I'm willing to do that. But I don't, this was the bulk of what I really wanted to share.
Okay. So there were a few things that you laid out earlier, and you know, there's obviously people in here who get a lot of the things that you were talking about, and based off of the questions, they could understand it. And I suspect that there's also people who they're like, I have no clue what he's talking about. And, you know, and they're going to go run to, you know, their accountant. You pointed out 3 things earlier that a typical accountant would probably miss that could be very beneficial to people. What would be, you know, a couple of practical things that you would say, you know, here are some things that you just really need to stay focused on? If there was like, you know, a couple of takeaways that somebody we're going to walk away from here with.
I think first and foremost, just taking the step to do your planning. I used to think that a lot of people would take the step, and then having worked with so many people over the last few years, I've realized that almost nobody does their own tax planning, or they don't even think about it. So taking the time to use this Excel spreadsheet will probably take you maybe a half a day to get through, maybe a little longer to pull together certain records. But knowing where you're at and that proactive thinking, this is where, depending on if you're simply a W-2 employee, there's probably not much you can do. But if you've got a business where you're making $100,000 up to $500,000 a year, you may not be in that point where it makes a lot of money to spend on a big CPA. But having some idea of that is where you can start to implement some of these changes yourself, and you can start to do some of this.
So, you know, Keith, in talking to you, there have been a number of times that you've expressed, you know, frustration to me about people who there's little things that you can do for them that would save them tens of thousands, $100,000 in taxes. And they tend not to take those steps because they're just too busy, or somebody else convinced them that it can't happen. But this is where the planning really comes in, that to sit down for a few hours and to really dig deep in and to take a hard look at these things, can really amount to a lot of money. It's not just, it's not necessarily saving a few $100 here. In some cases, it amounts to many thousands of dollars.
So to build off of that, the tax code is complicated. It is over 1 million pages worth of regulations. I've somehow been able to find it enjoyable, which means I continue to read about it and have fun with it, because it just takes a certain part of my brain that likes the strategy. Most accountants aren't like that, though. They're not always on this hunt to find new information. Just like any profession, you get into your comfort zone. This is what I know. This is what I want to do. I don't necessarily want to study this. So to an extent, if you're able to take time to read a little bit, read a book about tax strategy, read landlord deductions, if you can educate yourself, this is the kind of stuff that can save you over the course of your lifetime hundreds of thousands of dollars, if not millions. So as you grow in size and sophistication, this is more important. And the CPA you started out with when you first started just needing an accountant to help you with your filings is probably not the guy in the right niche to take you to the next level. So I know I've known so many people who have said, well, I'm going to stick with so-and-so. He's a nice guy. He's stuck with me for a lot of years. He's cheap. Often cheap means not the most value. And some of the cheapest advice, because of all the missed tax deductions, ends up being some of the most expensive services you can ever have. So knowing when to spend. So when you can go out and study a little bit of this on your own and understand a few of these concepts, and you're bringing up to your accountant and they've got no idea, you've got the whole internet at your disposal now, where you can access a few experts that really do know this stuff, and your accountant has no idea what you're talking about. It might be time to get another opinion or encourage them to at least educate themselves. So I know many of my clients have pushed their accountants to be better people, and the people I work with, I often end up educating their CPA, not in a supportive manner, but then they can also then apply the same stuff I teach them to all their other clients. So it's kind of a win-win.
Awesome. All right. So PPP and EIDL, we never experienced that before. How is that going to affect people tax-wise this year?
Still up for debate. Quite literally, PPP loan is getting debated in Congress now. So Congress would say when they originally gave that there weren't supposed to be any tax consequences for the PPP loan, that it was not going to be recognized as income, and it was not going to recognize, you were still going to be able to take the deductions. To me, from a tax perspective, logic perspective, if I use the PPP loan to pay my employees, it means I'm using somebody else's money to pay something else. So if I'm not having to spend my own money on something, then it makes sense to me that I even have to recognize that as income, as debt forgiveness, or I shouldn't get to at least take the deduction. IRS has that viewpoint where you either need it as income or you don't get the expense. Congress is saying, actually, you don't have to recognize it as income or an expense, or that's at least what's getting debated right now. There's a kind of a war going on between Treasury and Congress. EIDL loan will just be treated as a loan. You should be able to deduct the interest expense associated with your business like you normally would.
So as far as PPP is concerned, do you foresee that a decision is going to be made sometime before everybody is processing their tax returns? And
I think it's in the interest of both parties to get a decision made on that. And both parties are, I think, united in not wanting to make it taxable. So I think it'll come out soon, but this might be one of those where maybe you wait. If you did a PPP loan, maybe you wait later, you extend to give more time for that information to come out, because it'll probably, maybe it gets made in March, and you want to be able to make your decision based on that then, so you're not having to amend.
all right. So we have someone who bought an RV so that they could travel the country looking at storage units.
Awesome.
How does that work as far as expensing it?
The part that you can substantiate as a business that's related to actual business, would be, I think, deductible. So you're essentially traveling in your business office, but we know that I doubt that all of that is 100% business. Actually, that would be a flag to make it 100% business. So I would look at the number of days related to your business travels or why you're in a certain area. If you're bought a self-storage unit in San Diego, then maybe it's an easier, it might be more questioned why that's not more personal, versus if you're in the middle of the desert or someplace that's not so nice to visit, then you could probably substantiate more of that as business.
Awesome. All right. So again, I just want to reiterate, because I just had a question. We're going to put the recording of this inside of the Life in Air app along with Keith's spreadsheet. We will just put that as an attachment to a post inside of the app. So you can go in there and look for it. It'll take us a little while to get the recording, but I will get those in there. We'll just start a post. Any questions that anybody would have as it pertains to this discussion or anything, you can just actually respond to that post, and we'll keep the discussion all there in one place. Keith, can you tell us, everyone, again, some people came in a little bit later, I had you at the beginning of the call mention how they could find you, or, can you tell us again?
Sure. My website, financialjourney.life, or my email is keith@financialjourney.life. I will say I'm not looking to take a bunch of tax emails and tax questions to get into everybody's situation, since that's not my business, but I'm willing to be on this call for a little bit longer and answer any questions you're willing to ask in a group. Or if you go back to the Life in Air app, there's myself. I know that there's at least another CPA in the group that might also be willing to help you with your questions there.
Yeah, I think that if you ask your questions in the group, the majority of them are going to be able to be answered by somebody who is in there. And if there's something that gets very specialized, and Keith pops in there on occasion too, and as a contributor there. So I would just encourage you to ask your questions there. All right. Well, Keith, I appreciate you. I thank you for doing this. I know that it's be very valuable to a lot of people. I just hope that everybody who is on here, you do take the time to plan, as Keith suggested. It's in your best interest. It takes some time. There's no question about it, but that planning is what's going to make all the difference and save you considerably. I oftentimes bring up that it wasn't that long ago that Trump's tax returns came out, and there was this whole uproar that he only paid $750 in 2016. The reality of the situation is this, I haven't seen his tax returns, but he's not the one who set up the tax laws. He's not the one who put the rules in place. He just used the rules that were there to his benefit. And those same rules are available to all of us. And we're the ones who get to choose whether or not we use them. And if we miss them or we don't take advantage of them, the only people we can blame is ourselves. And we pay more when we don't use them. So I just want to encourage everyone. I feel like, most of us, even though we might not pay that much to the government, and you might feel like, well, somebody like that should pay more. The reality of the situation is it comes back in many, many other ways. All the jobs that are provided, all the investments that are made that grow in other areas. So I think being a good steward of your own finances, your job should be to get your own tax bill down as low as you can, so that you can do other things that actually do contribute to and build the economy, our culture, providing jobs, being able to give, and things like that.
And if you're like Warren Buffett or Bill Gates that feels like your tax bracket is too low and it wants to complain about that, I will say that the IRS does accept donations where you can send a check to the IRS and they're happy to take your money.
Yes. Not too many people ever take them up on that. Even the ones who say that we should be paying more, they never actually do it. So,
Keith, what do you think about actually simplifying our tax codes? I know every time the federal government changes and reforms the taxes, they call it simplification, but it never is. I
think it'd be good for everybody. I I don't think I'm going to be out of a job anytime soon, though. I think there's too many lobbyists that like their specialized brackets, and there's so much, I don't know, adversity in Congress right now that I think that's likely. I think the other thing they should do, at least from a government perspective, I don't personally love this, but I think they should give the IRS a lot more money. They get a great return on that, and the IRS should be auditing a lot more people, and they'll find a lot more. But I don't personally like that, but I think that would help with tax revenue.
Yeah, it's just right now with this pandemic, we're going through the federal government, the state government, the local government, businesses, individuals don't have as much money, period.
Nope. So frankly, because of all the complication, I see safety in complication. I've realized that I like complication more than a lot of others. Or I'm able to deal with it, which means there are all sorts of complex rules that once you learn how to use them, you can save a ton on money. And legitimately, there's been clients I've worked with who have 8-figure net worths doing real estate, and we can legally go a decade without paying any taxes, just the way things work out. So maybe on another presentation, I'll go through the details on how to do that.
Well, thank you for all the information and the expertise you gave us today.
Thank you.
Thank you, Keith. If you'll send over that spreadsheet, I'll go ahead and originate a post in the app. We'll get that out there to everybody, and we will get the recording out to you as soon as we can. Thanks everyone for showing up, and Keith, we appreciate you.
Thank you.
Have a great day.